If you're making $100,000 or more and you give to your church, your HBCU, or your community, I may be wrong, but I suspect you've noticed that the more you earn, the more the system tries to penalize your generosity. Starting in 2026, new tax laws are essentially putting a tax on your giving. Wealthy families have not had penalties for decades by using a tool called a donor advised fund. Nobody told you about it because they've assumed you just keep giving the traditional way. Hi, I'm Destiny, and today I'm giving you permission to stop giving for free and to start giving like an institution. My mission is to bring these type of high-level strategies to everyone. First, let's break down what a donor advised fund, or a DAF, actually is, because the name makes it sound more complicated. Think of it as a personal charitable foundation without the $50,000 in legal fees. In my practice, I treat a donor advised fund as a strategic brokerage account for community impact. You open a donor advised fund account at a place like Fidelity Charitable, Schwab Charitable, or Vanguard Charitable. There's also even a new easy-to-use digital platform called DAFI, which has lower fees and a much smaller minimum. I'll put the link in the description below. You contribute money or assets to that account. The contribution can be cash, stock, or even real estate. The moment you contribute, you get an immediate tax benefit in the form of a deduction for the full amount. But the great thing is that you don't have to give that money to charities right away. It sits in your donor advised fund. It can grow tax-free if you invest it, and then you distribute it to your charities over time. So that could be this year, next year, or even 5 years from now. Most people give $10,000 a year from their heart. It feels like your generosity is being ignored by the tax code. We're going to flip that frame. Instead, giving $10,000 annually, we use a strategy called bunching. With bunching, you put 5 years of charitable giving into a DAF today. You take a massive $50,000 deduction right now, shielding your income from the highest tax brackets. And then you distribute that money to charities over time. You see, you're giving that same amount total over that period. You're just timing it strategically to get the tax benefit. This is something to address ASAP because as of January 1st of this year, the 0.5% AGI floor and the 35% cap for high earners are officially in play. If you aren't auditing your giving strategy this quarter, you are voluntarily leaving money on the table, and that belongs to your scholarship fund or your church. That's a loss of legacy. Black and brown professionals are more likely to give back to our communities, our churches, HBCUs, scholarship funds, and social justice organizations. We give from the heart, which is beautiful, but we're also navigating wealth building for the first time in our families. We're closing generational wealth gaps. We need to give strategically and generously, not one or the other. That extra $10,000 to $20,000 you save in taxes through a donor advised fund, that goes to your kids' 529 plan. That goes to building your wealth. That goes to giving even more next year. Now, this is the specific move I look for when building a tax-efficient plan. Instead of donating cash to your donor-advised fund, donate appreciated stock. And I may be wrong, but I bet you have stock in your brokerage account, maybe Apple, Nvidia, or an index fund that has grown significantly. If you sell that stock to donate cash, you're paying capital gains tax. If you donate that stock directly to your DAF, that tax disappears. You get the full deduction and the charity gets the full value. This is how sophisticated wealth is built, by never paying the same tax twice. For that technique to work, you must have held the stock for at least 1 year to get the full deduction. If you've held it less than a year, you can only deduct what you paid for, not the current value. So this strategy works for long-term holdings, not short-term trades. And as always, confirm your specific details with a tax professional. Okay, let's make this practical. Here are the actions step by step. But before I give you the steps, I want you to know that you can absolutely do this yourself. But the reason people work with a planner like me is to ensure this isn't happening in a vacuum. I sync your DAF with your Roth conversions and your overall investment strategy, essentially being smarter than the tax code. Moving on to the steps. Step 1. Open a donor advised fund. Like I said, you can check out a few plan sponsors like Fidelity Charitable, Schwab Charitable, or Vanguard Charitable. I'll put the Daffy link in the description. Creating an account takes 15 to 20 minutes. Minimum opening balances can be $5,000 at some companies, but it's much, much lower with Daffy. Step 2. Calculate your strategic contribution. Look at your last 3 to 5 years of charitable giving. Let's say you give $12,000 a year. 12,000 times 5 years equals $60,000. You can consider that the possible target contribution amount into your DAF. Step 3. Choose what to donate. Look at your cash versus what I mentioned before about donating. Step 4. Make the contribution. Step 5. Take the tax deduction. Your donor advised fund will send you a receipt. Give it to your CPA when it's tax time. If you contributed $60,000 and you're in the 35% tax bracket, you just saved $21,000 in taxes. Step 6. Distribute over time. From your donor advised fund dashboard, you can send grants to charities whenever you want. Set up recurring distributions or distribute as needs arise, such as disaster relief or special campaigns or just spontaneous giving. If you do this before December 31st of any year, you get the tax deduction for that tax year. But you can distribute the funds to charities anytime in the future, no deadline. Look, the tax savings should go back into building your wealth. If you give $8,000 or more to charity annually, a donor advised fund might make sense for you. I'm not here to tell you how to save money just so you can see a bigger number on a screen. I'm here so that extra $12,000 or $20,000 in tax savings goes into your legacy plan. We are closing the wealth gap, y'all, by being the architects of our own capital. If you're ready to stop giving by accident and start giving by design, hit the subscribe button. It's the easiest way to signal to yourself that you are no longer just a spender, you are a strategist. Drop strategic in the comments if you're opening your DAF this year. We are building for the future, y'all. See you next time.